Hello everyone, welcome to another episode of Financial Tidbits here with me, Royston at NAOF. In today's video, we'll be broaching on the topic of stock market correction, which I thought is timely since the market is currently undergoing a mini correction and this is already freaking people out. Those who belong to the bear camp will be saying something like this. See? I told you that a correction is coming, right? Because the market is so overvalued. If you listen to me, then you will not have lost money. I want the market to tank even more, then I can bottom fish at a cheaper price. In the meantime, I'm going to make money shorting the market big time. But these people who seem like oracles will all of a sudden go radio silence when the stock market demonstrates a quick rebound. They will then appear again to sound like geniuses when another mini correction happens. Those who belong to the bull camp will say, hey, history has proven that this is an opportunity to buy on the cheap. Every time it dips, I buy more. It dips more, I buy even more. The market is on sale. Time to get greedy. Buy, buy, buy is the mantra of the bulls. So far, the bulls have been proven right as the market has indeed rebounded after every mini correction. So which camp do you belong to? Are you a naysayer who is perpetually bearish on the market, someone like Mark Faber, who has been transmitting that the next market crash is always on the horizon for the past decade? Or are you a bull like Katie Woods, who believe that such minor corrections are healthy and it's an opportunity to buy more? I personally remain in a long-term bull of the stock market, and being a long-term bull means I'm not prepared to pull out all my investments and sit 100% in cash and wait for the market to correct significantly to bottom fish. For those who have been sitting on cash waiting for the next big crash to happen, for one, that might never happen. Even if it does happen, say for example during the COVID-19 flash crash back in early 2020, for those who are flush with cash, many will not take any action as well, anticipating even more downside risks. Before they know it, the bull is back in full charging mode and they are still sitting in cash. As the saying goes, cash is king. That is, until inflation makes it a pauper. Being a long-term bull doesn't mean that I ignore the possible risk of a major market correction in the short term. I've written about such risks in my articles at New Academy of Finance with the view that the next market correction would be triggered by a rising inflationary environment which forces the central government to raise rates or to taper prematurely. That will result in a massive tantrum. The current mini correction, I believe, is a direct result of the 10-year bond yield rising, and if that rise continues on an accelerated pace and breaks 2% in October, that will really spook the market. However, if the yield falls off, then a market rebound will likely happen again, in my humble opinion. So, what exactly is my strategy? I've mentioned earlier that I'm a long-term bull and I'm reluctant to go all in into cash. First, I've always have a pool of capital waiting to be deployed in the event of a significant market correction. This is typically done for my passive portfolio, which is invested passively in the broader market using a dollar cost average approach. If the market dips 10%, I will deploy 25% of my spare capital into this passive portfolio. If it continues to dip another 10%, I will deploy another 25% of my capital, so on and so forth until the market drops by 40%, by which I would have fully deployed all my spare capital on hand. Yes, the correction can definitely extend beyond 40%, but unfortunately I don't have a magical crystal ball in front of me and I can never claim to be able to buy at the bottom, unlike what some bears will claim to have the foresight. Second, I take the opportunity to trim or exit some of my positions in my active portfolio. Most of the time, investors are unwilling to cut losses on their losers, while they take profits on winners too quickly. I admit I do have that issue as well, but I have learned over the years to cut losses on my losers and let the winners run. This is now the time to relook at your portfolio, bite the bullet and dump your losers, and use the spare capital to buy into some of your better quality names which are now trading at a discount. Third, I engage in some form of hedging using options. This is slightly more advanced and might not be the cup of tea for most investors, especially those who are unfamiliar with options. But I usually tend to allocate a small portion of my capital to purchase hedges, specifically buying put options that will see their value rise when the market corrects. I will then progressively take profits on the put options and recycle them into buying longer term, high quality stocks. That, in a nutshell, is how I typically approach a stock market correction. Again, I'm not saying that this mini correction is just a mini correction and a rebound will happen shortly. It could well turn out to become a full-blown bear market this time around, and the perma bears will finally be proven right after having lost all their capital shorting the market in the past decade. It is good to be mindful of the risk among us, but it also pays to be a long-term investor in the market. Unless you have got a magical crystal ball in front of you, I believe that the prudent thing to do is to have a proper investing plan. That could be simply to engage a dollar cost average approach and invest consistently into a passive portfolio, either through the purchase of index ETFs or through a robo-advisor. If you have got spare capital on hand and wish to capitalize on market drawdowns, there might be time to put it to use, just like what I highlighted earlier in my spare cash deployment strategy. With that, we have come to the end of this short video. If you found the video useful, do give it a like and subscribe to the NAOF YouTube channel. Do also leave a short comment in the comment section on how you look to approach a market correction. With that, this is Royston signing out.